Right, hi there. My name is Richard Perry. I'm the market analyst at Handset Markets, and this is my webinar that I'm going to be holding this week on unemployment and non-farm payrolls. It's non-farm payrolls Friday this week, so payrolls are very much going to be in the focus towards the end of the week, and it's probably a good idea to have a look at them and have a look at the sort of theory behind unemployment levels and how they drive markets. So what I'm going to do now is I'm going to switch you guys to my screen, so that, now you're going to be seeing my slides, and this is, as I said, this webinar is called How Unemployment Indicators Can Drive Financial Markets. And before I get into it, let's have a quick look at the disclaimer, because I'm going to be talking about live market information as I go through. I'm going to talk about, for about half an hour, hopefully, on unemployment and non-farm payrolls, and then I'm going to be looking at some forex market stuff. So anyone who has got any questions or any queries or anything, please give me a shout. Here's the webinar agenda, starting off, as I said, with unemployment data and how it can be key for markets, looking at the importance of payrolls, and then looking at these specific asset classes such as bond markets, forex, equities, and also gold. And then, as I said, the live market analysis, and you can ask me whatever you would like. So let's get into this. Okay. Now, I talked previously about indicators such as, well, what the central banks do as monetary policy and also inflation. But I think the sort of next step to take is to look at unemployment, because unemployment is very important, and it can have a significant impact on monetary policy from central banks. And certainly, unemployment is a key indicator to look at how an economy is actually performing. And if you look at, say, for example, the economy is as being in strength, then jobs will be created. The level of unemployment will be falling. So if you take that as a cycle, then the creation of jobs will mean that people are going to have more money to spend, and therefore improve economic activity, and subsequently generate more and more jobs. And the sort of virtuous cycle will continue. So it certainly can be a positive thing when jobs are being created and unemployment is falling, and subsequently it will have a big impact on monetary policy, because it can have a leading impact onto inflation as well. Now, obviously there is a clear political benefit from pulling unemployment lower, but it's going to be ultimately often a direct aim for the central bank as well. I mean, certainly the Fed, for example, has it as its as part of its dual mandate, the pursuit of maximum, or I think it's the pursuit of full employment. So that is actually written in statute for the Fed that it has to follow. That's why the Fed always talks about unemployment and how the labour market is doing. So as you can see here, what you've got is the flip side of unemployment, which is being bad for the economy when unemployment goes up. You can see here in the little diagram here that the guy who is formerly employed has got to make some big decisions in terms of his spending patterns, and things get crossed off the list when you don't have the money to be able to do that. So that has a direct feed through into the economy, and if that happens in aggregate, then you're going to see a significant impact on that. So what specifically the Fed, I would say, does is try to tackle rising unemployment through monetary policy, and to try and make the monetary conditions far more favourable for job creation. And the main way of doing this is to reduce interest rates, making it cheaper for companies and individuals to borrow to create that wealth. Now, as I said, central banks are ideally sort of looking to sort of achieve that level of unemployment where inflation is stable, and that's generally tends to be a laid out aim of central banks to achieve stable inflation. but obviously unemployment can change and therefore has an impact on inflation. So the two are quite often very closely linked anyway. And through through economics, we get sort of the level of the Phillips curve and also NIRU, which is the non-accelerating inflation rate of unemployment. Now, the Fed officials will often talk about the Phillips curve and how the Phillips curve and NIRU are moving in terms of the level of unemployment that's going to start to generate inflation. And it seems as though that we're beginning to get a little bit of traction in this now. And oh, sorry, don't know what's going on there. It seems to be that we're getting a little bit of traction in this now, because unemployment has been falling consistently, as you can see through this chart here. But the Fed estimates of NIRU were falling consistently alongside it, because as an inflation was going along, continuing to fall, you weren't getting any inflation. And sorry, as unemployment was continuing to fall, you weren't getting any inflation. So the estimates of NIRU were continuing to change, because through economic cycles, which are tend to be different from one to another, you get different levels of NIRU, and the non-accelerating inflation rate of unemployment seems to have been falling and falling in the last few years. However, are we now at the point at which it's starting to pick up? Because unemployment has sort of dropped below 5. And we're starting to see signs of inflation now. Not massive signs, but signs of inflation are starting to come through. You're seeing wages pick up, and you're also seeing sort of like the core PCE, which is the personal consumption expenditure, which is the Fed's preferred rate of unemployment or measure of unemployment. That is starting to pick up as well. So are we now beginning to see the level of NIRU being crossed by the unemployment rate? It is something that Fed officials are considering. So why does unemployment matter? Well, as I said, sort of the controlling of inflation being the second part of the Fed's dual mandate, which is the pursuit of maximum employment, being written into law, makes it legally bound to engage monetary policy that sort of pushes towards the pursuit of that full employment. So therefore, it does matter to the Fed, and labour market policy or the condition of the labour market is obviously a big concern to the Fed. Now, as a general rule, you would say that falling unemployment would lead to higher consumer spending, and also help to create tax receipts as more people pay income tax. You got the level of government spending. I mean, it's not necessarily going to fall, but it means that the government can lower spending, because it's sort of gonna it's going to be generating more through taxation, but also having to pay out less on social security benefits. So the government will need to borrow less, and generally, I think the state of the economy would be improving. And as I said, it's a virtuous circle and has knock-on impacts throughout asset classes because of that, and the impact that it has on the economy. Now, very quickly, is it a lagging indicator? Well, unemployment is always considered to be a lagging indicator, but I thought I'd just sort of drag this chart up, which sort of compares how unemployment went through the late 2000s, really, and the impact of non-farm payrolls and how it sort of coincided with moves on the market. Now, obviously, the big move in the market came in sort of mid-2007, where the market started to drop off. And in mid-2007, you started to see the level of unemployment rising. You started to see the payrolls significantly had been already on a downward track. You could argue on a downward trend, and started to sort of become more lower. It actually started to cross into negative territory on the payrolls data in early to mid 2007, and it sort of coincided with unemployment starting to go higher, and also the market hadn't actually been falling until that point. The payrolls had started to go negative, but the stock market hadn't started to fall, which is interesting. Now, we did see the dollar weakening through that, but actually we started to see as payrolls accelerated lower, we started to see the dollar strengthening, and you could argue that maybe that was a safe haven trade because that was in the midst of the financial crisis, and obviously markets around the world were plummeting, and they were seeing the dollar as a safe haven. But it's interesting that we saw this, certainly the stock markets as well, peaking out well before. Well after the payroll started to go negative for the first time. So, was that actually an indication? Well, I think it's my point would be that I think unemployment is a confirmation tool rather than a lagging indicator that you just avoid. I think it still needs to be looked at, and I think it is still a very important indicator. So non-farm payrolls, it's non-farm payrolls this Friday. Current estimates, I think, are around about 200,000. Let me just see on payrolls. Current estimates for payrolls. Sorry, I should know this, but I think it's around about 200,000. Unemployment payrolls 206, so it's slightly lower according to sort of the estimates in the market at the moment, around about 206, 205,000. Now, payrolls has a significant impact across the market and asset classes. It's generally seen to be the sort of most important data point of the week, of the month, and it has. Basically, it's because it gives a very, very strong indication of how the US economy is performing. The US is the largest economy in the world, and markets around the world need to know how that economy is performing. So it has a big, significant volatility impact across asset classes. Now, non-farm payrolls comes out in the employment situation report. With a whole batch of data points. You also get the unemployment rate, you get the average hourly earnings, you get labour force participation rate, you get a whole range of indicators. Now, I think, in my opinion, I think that I think the whole report needs to be taken in aggregate. I don't think you can look at the headline payrolls and just think, right, okay, well, if payrolls have beaten estimates, then you've got to trade with that way. You've got to trade for a stronger dollar. I don't necessarily think that's going to be the case, because the Fed is looking, as I said, at other aspects of the labour market, average hourly earnings especially, and also labour force participation rate. I think increasingly becoming important now, because average hourly earnings give a sign of inflation down the line, so that is certainly very important. And also labour force participation rate, I think, again, very important, because we've got the fact that let me just show you a chart. Actually, this is if you can see that, it's a little bit small, but you can see that the participation rate has been falling for years, actually. So the question being, is participation rate actually better for measuring employment or labour market trends than unemployment? Because unemployment has been falling, but unemployment is is where people are actually filing for social benefits. I think through I can't remember what it's called. Is it Social Security? Anyway, they're actually filing for those jobless claims effectively. And the participation rate is the level of the work of the labour force that is actively involved in the labour in work, and that has been falling away. So you could argue that has been a trend that has impacted on the unemployment rate. But now the labour force participation rate has started to tick higher. You could argue also that now will start to mean unemployment will go up, because the more people that are in the market that are looking for jobs, the more people arguably may not have jobs, so that would increase the unemployment rate. So you could argue that the participation rate is more important than the unemployment rate. So the Fed certainly looks at that, and Janet Yellen talks about the participation rate quite a lot. But also I would say the average hourly earnings are very important as well. So you need to see average hourly earnings picking up, because again, it is a sign that that Phillips curve and the Nauru level has been reached when wages start to go higher, because it would suggest that the supply of labour has fallen to an extent at which people are starting to demand higher wages to change jobs, and that would be sort of the point at which Nauru starts to pick up and or cross, or the unemployment rate would cross the Nauru level, and you're going to start to see wage inflation as well. So it all sort of feeds into this same situation. Now you've got this payrolls employment situation report, and you've got the example here, November 2015. What a strong payrolls report this was. You had non-farm payrolls around 100,000, I think it was, above the expectation. I think it was 271 versus the expectation of 170. But also you had average hourly earnings growing at 0.4% for the month versus an expectation of 0.2% for the month. So you started to see average hourly earnings pick up, but also strong labour sort of job creation as well. So that's an unambiguously strong payroll support. And what happened? Well, we had euro dollar fell 140 pips in a minute. So you had a really strong move on payrolls, really strong report, and a strong move in the dollar, strong move on euro dollar to the downside. Not only that, you saw gold dropping $16 in a minute as well. So again, you got across asset classes. So you need to watch out for gold. Gold is a very volatile mover on payrolls. And I've noticed, and it is a really strong, has a negative correlation to the dollar for reasons of it being priced in dollars, and subsequently when the dollar strengthens, the gold price will drop, and that's exactly what we saw here. It dropped $16 and actually kept falling as well, so there was still an opportunity to trade it after that. So it does have a big impact. And here you can see what I was talking about in terms of the employment situation report, average hourly earnings, participation rate, and unemployment. You've also got other employment indicators which are very important, certainly for the US. Weekly jobless claims, yeah, not so much these days, because they are historically very low, and just basically are a confirmation that unemployment is towards sort of record low levels. But also the ADP employment report. Now the ADP is a private payrolls company. I think it's issues paychecks. I think I might have got that wrong, but it basically produces 2 days before the payrolls report a very sort of a similar sort of number to payrolls, and it's considered to be the private payrolls effectively. And it has in the past, although its sort of correlation now is not as strong as it was. It can be a bit of a mixed number, but it can certainly give an indication of how payrolls are going to do a couple of days later. You've also got things like the JOLTS, job openings, which can be important, and also I think the quit rate is probably more important than the JOLTS. The quit rate basically is where where labour market participants sort of are more confident about their jobs, so they are more confident that they can quit their job and find a new job rather than sort of staying in their old job because they're worried about the labour market and the strength of the labour market and being able to sort of change jobs successfully. So the quit rate is a pretty positive correlation indicator to how the labour market is doing. Okay, so how does this all impact on markets? Well, look, starting on forex, really, you can certainly say that domestic currency is going to be very volatile to the unemployment rate. So if you're looking at sterling, you'd be looking at the UK unemployment rate. If you're looking at the euro, you look at the eurozone unemployment rate. If you're US sort of payrolls as well. So the domestic currency is a big driver of markets in terms of unemployment. So basically what you would say that any positive surprise, say for example you're looking at payrolls, which we're going to be doing on Friday, any positive surprise would strengthen the dollar. So improving payrolls is positive for the economy in terms of growth, and also if there is a strong increase, it could indicate that there could potentially be impending inflation further down the road. So it is basically the impact that it would have on Fed monetary policy and the potential for increasing interest rates. So the Fed obviously, if it sees the labour market really strong, it would theoretically need to raise interest rates to try and sort of take the steam out of that, just in case inflation was going to be building up. But generally speaking, what we have to do is just look at the payrolls report as a whole. And again, mixed payrolls reports will drive a big volatility in the markets, because there's no real sort of convention as to exactly how the markets will look at it. And obviously we've got all the algos as well that do the immediate market reaction. And I mean, I don't write algos myself, obviously, but you can imagine that they're all sort of geared towards the headline payrolls number. So if headline payrolls number comes out really strong, but there's no earnings growth whatsoever and the labour force participation rate has dived, then you would argue that the initial reaction is likely to be unwound. So if you get a mixed payrolls report, you're likely to get a big retracement of the initial move. It may start to sort of be solid again and carry on in the same direction. But I think you've got to watch out for the spikes on payrolls reports, because they can be very significant, and it's really interesting. And now here we go. Here we have the payrolls report in January. Similar sort of situation. As I said, you got the headline payrolls that were strong, and subsequently the market started to consider the fact that earnings growth was much lower than expected. I think that was the month that earnings growth was negative by minus 0.1. And subsequently the market started to turn around again. So you've got to take the whole payrolls report, I think, and not just look at the headline numbers, certainly for impacting as it did in January on the dollar. Now the impact on bonds is obvious, because again the correlation between certainly on payrolls report, the correlation between unemployment and obviously monetary policy, and monetary policy certainly drives the bond market. So they are interlinked, and you can see again a lot of volatility. And the volatility on this chart once more, you've got the initial sell-off on treasuries, because the payrolls report was sorry, the non-farm payrolls headline was positive, but then subsequently the market sold off again as and tailed off on the earnings growth. So you saw the spike higher in treasury yields, or this is the 2-year, before subsequently the yield fell away again. So you will get volatility through the markets, and certainly that's exactly what happened in the 2-year treasuries in January. Okay, impact of unemployment on equities. Here we see, this is interesting, because here we see the again the January report. We had those strong headline payrolls of 292. FTSE rallied on the back of that. You can see that. This is a 1-minute chart, so it rallied for about 4 minutes before again turning round. So all these markets do tend to move in lockstep, pretty much. They you don't often get markets moving out of sync on the payrolls report. You do tend to see them all moving in lockstep. So if you are sort of if you're trading across asset classes, you need to be careful that you position in a way at which you're sort of not overly exposed, I think, necessarily in one direction or the other, but just bear that in mind. As I said, here we go on in the grey box. More people in work means the economy will be stronger, so you're getting less government spending, better tax receipts, better consumer spending, stronger housing market, and generally better conditions for corporates. So I think that is sort of the crux of it, isn't it? Is the fact that a better economy generally, it just means it's a better environment for corporates to do their business. Now you do have again, as with a lot of economic indicators with equity markets, you do have these sort of slightly mixed reaction sometimes that you get with the fact that a strengthening economy is obviously good for corporate environment and good for consumers, so tend to be beneficial for equities in that regard. But if it leads to sort of rapidly increasing interest rates, then it's not necessarily as positive for equities in the long run. But certainly the initial reaction on these data points will tend to be positive for equities. And finally, onto gold. Again, looking at the January report, and once more we saw the initial reaction to the downside on gold as the dollar strengthened on the back of those 292,000 payrolls. But again, the lack of earnings hitting through. Again, as with the FTSE, 1, 2, 3, 4, 5, about 6 minutes of downside before the market turned around. So once again, all these markets do tend to move in lockstep on these employment. On these economic indicators, and certainly on non-farm payrolls on Friday, you'll notice that that is the case again. So gold is a volatile mover on payrolls, and I think gold is one to watch, certainly on Friday. Certainly with the extreme moves that we've been seeing recently, if you get a strong payrolls number, for example, you could see quite a sharp retracement on gold because there's been a lot of gold strength recently. But I'll talk you through that in my charts in a bit. So that's sort of the theory side of my presentation. Now let's have a look at the markets generally. Now, we've had this breakout on the euro dollar, and to be honest, it was a strong move, but it is eerily similar, isn't it? I think to this one here, could be. We had this strong breakout, closed above, nice strong candle, but yesterday massive. I mean, I'd sort of call that as a shooting star in my morning report. I mean, I'm sure if you want to get really sort of picky, it's probably not a shooting star, because that maybe the candle body is a little bit too large for that. But still, not only did we see a significant intraday reversal from that high at 1614 to close, over 100 ticks lower from that high. This is coming as the RSI hit 70 again. Tends to be sort of the limit, doesn't it, in these moves? You're seeing the stochastics starting to roll over, and you're seeing this second day's confirmation. Now the old resistance is 1465. Now that old resistance was consistent through months of trading in the last sort of 16 months. So that sort of the breakout above that, if it goes back below that, that's sort of, I think, confirmation of the near-term correction that I think you're going to have in euro dollar. And I think the correction could well come back now into this sort of 13 sort of 95 towards, sorry, 1330 towards 1395. Now if I show you on the hourly chart, you can see that 1450 is around about where there is the old, as I said, the intraday hourly chart support comes in. But 1395 is this breakout here from the 21st. And I think between there and sort of 1450, I think there's a pretty decent band of support there. And it'll be interesting to see how this correction takes hold, because it certainly looks at the moment as though the way these indicators are sort of maneuvering themselves, that if it sort of breaks below 1450, you could argue there's again 1445. It's a minor reaction low, sort of minor reaction high. So you could argue that, and that sort of coincided with all these highs here. You could argue that you're sort of back towards that 1395 area near term, and it'll be interesting to see, as I said, if that is an area where we start to find support. 1330 is a breakout level as well, and provided the floor for all this congestion back a few weeks ago. So that again is a level of support. So sort of between 1330, 1390, I think you could see that the move goes back into that if you see the correction really taking hold and moving below 1450. So I think a near-term correction, I think, is what we're going to see on Eurodollar, certainly with that negative candle there, that shooting start. Now, it's so interesting because we've seen reversal signals across the board pretty much on all these charts. Now, what I'm going to do very quickly is actually show you the dollar index, because the dollar index broke through. Look at that massive support, that low 92.60 got broken the last couple of days. Never got the closing, really got the closing breakdown. You could argue it was a very slight breakdown, 92.59 there on the close, but never really got that. And the argument being, was that a false downside break? And you could now see an unwinding. And that dollar index, where would you see that unwind to? Well, I think that's a pretty good level. Pretty pivotal. 95.15. So you could see a fairly reasonable size bit of correction on the dollar, actually, on these dollar charts. And looking at this cable, certainly that is a big bearish engulfing pattern, isn't it, on the candle, or bearish key one day reversal, whatever you want to call it. Look at these momentum indicators as well. That's crossover sell signal on the stochastics, RSI falling away, MACD lines sort of losing traction as well. I think that we could see a bit of a near-term correction. My outlook on sterling is more positive than it has been. Again, it didn't quite achieve the breakthrough of that candle. Sorry, of that big downtrend, and it didn't get the confirmation break of that move above 1468. So you could argue that it still needs more work on the upside. But my expectation in the coming months is that I think we're going to see the UK choosing to, or voting to stay in the European Union, and I think subsequently that's going to create a big sterling rally. So I think this is going to be the basis of a base pattern. Exactly how this base pattern sort of forms, I'm not going to, I sort of don't quite know yet, because it could well have another correction. I think I mean, it's coming back already, not far off it, but 144 figure seems to be a bit of a pivot on this chart. So 144 figure, I think, is a pretty decent level to start thinking about if you get some support coming in there. And you're seeing what has become, or what had become, if I get the crosshair on it, a pretty strong RSI. Certainly the strongest it had become since August, or actually before then, since June last year. So almost sort of 11 months worth. And that was before the real sell-off started to come through. So that would suggest that the outlook is I think, improving. And again, the MACD lines, they're the highest they've been, again, since that June level. So you got RSI reaching the highest since June, and also MACD lines. So that would suggest you're more positively configured, I think, on the momentum on cable on the longer term basis. Near term, as I said, you could get some correction, which seems to be coming through, seems to be continuing today. You're down like sort of 65, 67 ticks. But I think that ultimately the UK is going to vote to stay in the European Union, and I think that's going to drive a sterling rally. and I wouldn't be surprised if through July, if we were back above 150 on the back of that. So that would be my expectation there. I think one back above 150 towards sort of 152 area. 150 to 152, I think, is a pretty decent area to think that a rally would come into on a Brexit vote that is remain in the Union, in the European Union. Okay, let's have a look at dollar yen. Again, another massive reversal signal. This time a bull hammer. A bull hammer, which is a bullish candlestick pattern. You started to see a rally. It just started to come up against the resistance there, didn't it? It sort of didn't quite make it. 107.45, 107.60 was this key low, and 107.80. So I think between 107.60 and 107.80 is your key near-term resistance. If you see the move above that, I think you could start to see some traction in a recovery. I really do, because then you'll start to see the RSI unwinding. The RSI's got a fair bit to unwind still, 34 at the moment. Still could get back into the 50s, and you'd still be negatively configured. I think that ultimately it would still be a rally that gets sold into, but I think that if you can get through 107.60 to 107.80, I think that is a rally on the cards for dollar yen. However, as I do stress that I think rallies are still a big chance to sell. On the long-term basis, this is a massive head and shoulders top pattern that gives you an maximum implied downside target, and that sort of gives you 105.20, which is in line with this big old pivot level. So I still wouldn't be surprised to see 105.20. I mean, it almost got there, didn't it? So it wasn't too far off it. 105.50, 30 ticks, but I still think that there is further in this to the downside. And ultimately, I think rallies are a chance to sell. Aussie dollar. Now, I've been looking and talking about this bearish divergence for a long while, and it finally came through for me. You do tend to find bearish divergences can sometimes be slow burners as technical signals, and you can't necessarily trade off them. You need to wait for confirmation. But look at the RSI falling away, MACD lines falling away, confirming or sort of giving you that bearish divergence. And we've seen a series of sell signals here. You've got bearish key one-day reversal there, or bearish engulfing. That wasn't quite another one. It was really close, within a pip of doing it. And yesterday, that was on the RBA. That was the inflation data, by the way. That last week, 27th, that was when inflation came out worse than expected. Sort of led to speculation that the RBA might move on rates, might cut on rates, but it was still not overly priced in, and certainly that would be the inference from this chart. That we had a big sell-off yesterday, and it's continuing as this dollar continues to strengthen. Now, support has been broken at 74.75. That key reaction low has been broken, and now obviously that reopens the next one, 74.13, which, to be honest, is not a million miles away from being a bit of a pivot, because 73.85, I think these highs are. Yeah, 73.85 are these old highs. I think we're coming back to there, and it'll be interesting to see what happens there, because you could then argue your support is between sort of 72.50 and 73.85. You've got a pretty decent band of support there. I wouldn't, if this correction does continue, I would imagine 73 figure area is probably a decent area for it to come back to. And then I think you'd get a reassessment of the situation on where the interest rates are going, and inflation, etc., etc. So, and how the dollar is performing as well. But that is, I still think we're in a corrective phase now, and further slide back towards 73 area probably wouldn't be unlikely. So let's go for the Kiwi. Look at this uptrend channel every time. Really good one, actually. Let's get rid of that. Don't know what that is. Big uptrend channel. Now you've got interesting, really interesting momentum indicators. That RSI every time. Mid to high 40s. Every time you see it back there, it tends to find support. Currently at 50. So is this now getting back to the realms of buying opportunity? Well, it could be, because once more you're seeing sort of not too far off another sort of key reaction high, whereby the old resistance becomes new supports, and you're getting this sort of sequence of higher lows, higher highs, and I think that is interesting. The only caveat, or the near-term caveat to that, is this big bearish engulfing pattern that we saw yesterday. But certainly, I think if you look at the momentum indicators, they are still suggesting that rallies are, corrections are a chance to buy. You certainly wouldn't want to see this correction though going below 68 figure, because that would start to see that would sort of confirm that as a lower high, and that would be a second lower low. So yeah, 68 figure is your support. I think you need to sort of keep an eye on there. CAD is another one, big turnaround. And again, gains today on CAD. Look at this downtrend I've drawn in here. It's now right bang on that downtrend. Look at the RSI coming up to a level at which all these rallies tended to fall over. So you're not too far off your next sort of crossroads. Your next crossroads on dollar, on the Canadian dollar, or dollar CAD. So this correction, this rally, which is a dollar rally or Canadian dollar sell-off, but more a driver of the dollar rally in this chart, I think, here this time around. But it's sort of getting up to a point at which you could have another go at this this key overhead resistance, 2830, which is the old floor, become new resistance. So 2830, if you started to see a move above that, and certainly I think the confirmation would be a move above 2990, which is this reaction high here, I think that would be your real confirmation signal that we've seen a basing out. Right, so let's look at gold, because we had that breakout on gold, but again it's falling back in. Reversal signals, that's a shooting star. We've had a subsequent confirmation candle there, and another one today. We're seeing the correction coming through. We're seeing the stochastics rolling over, RSI rolling over. I think now, near term, I think the support comes in at 1260 to 1270. I think they are the levels that you need to watch out for. Let's look on the hourly chart. You can see that rolling over effect. So you're getting more corrective outlook on the hourly MACD lines and the RSI. And as I said, that's the 1270 old resistance, new support, and 1260 is a level that was sort of fairly consistently hit through this range. So 1260 to 1270. If you lose 1260, I think that would be a little bit of a concern for the bulls. But you could still argue that whilst above sort of whilst you're above 1225, I think you're still sort of arguably intact with a bullish move. Now, just to show you, 1306 is this high here from January 2015, and then you're looking at 1322, 1345. 1345 is this really key July 2014 high. It certainly looks as though the gold price is just correcting back. I think it's what I would say is that it's sort of becoming a point at which corrections could become a chance to buy, because ultimately I don't see this dollar rally as being all that sustainable. I don't think it's going to go too far. Or let's go on, finish on silver, because I know FX Street webinar is about 45 minutes. So let's have a look at WTI. Big uptrend. Bullish momentum indicators. Little corrections, there a chance to sell. We've got that correction at the moment. You'd say that anything back to sort of 42 to 42.50, I think, is a decent sort of support band. You wouldn't overly want to see it below 42.50, 42.60, but we do have this sort of near-term correction. You've got this uptrend going as well. That uptrend currently comes in at 41. So there is still room for a correction, but I wouldn't necessarily want to see that falling below 42.50, 42 to 42.50. I think that's you'd want to see that being supportive. You can already see her writing and everything. You know what I mean? Right. So that sort of concludes it. Now, my website, handtechfx.com, is where I post all my research. Have a look, and you will see that I do morning reports and daily commentary every now and again. A few media appearances as well. So it's all there on our website, handtechfx.com. You can follow me on Twitter at handtechrich, and I post all my stuff there as well. So give me a shout if you would like to engage. Now, I haven't actually been told yet that I will go off, so let's have another chart. Let's have a look at the equity markets, DAX. G DAX I. Whoops. Let's have a look at the DAX. Yeah, that is a concern, actually. We've dropped back below 61.8. Now, 61.8% fib of this retracement, this massive bull run that we saw, the QE-driven bull run, I might add. Those fib retracements have been awesome on the DAX on a longer-term basis, consistently providing the key turning points on this chart. And if I zoom in here, you can see 76.4 has been consistent as well, but also 61.8 catching highs and also lows, but you've now fallen through that. So if you start to trade clear of 61.8%, that's quite concerning, because it sort of reopens these lows, 94, 95, 94.85 to 95, which were the March, April lows, and arguably also you're going to get a retracement back to 76.4, which is 93.07. So this equity markets correction that we're seeing at the moment is not all that great. It is sort of accelerating lower. The DAX stochastics are pretty bearish, aren't they? Pretty corrective. Seeing a MACD crossover, RSI falling away. If you saw the RSI falling into the low 40s, below 40, I think you could be really in some sort of trouble to the downside. So that is the DAX, and that is a difficult market to really sort of think that it's positive. And equities are in trouble. Let's have a look at FTSE. Oh, sorry. Let's try and get rid of that .FTSE. Yeah, FTSE below 62 is not good. 6114, 6036 is this key reaction low here from March. Again, FTSE and DAX both look as though they're going to be testing those levels. So low 6036 from March, April low 6062. And yeah, the momentum has just completely fallen away on FTSE. Stochastics, RSI. RSI is now lowest since mid-Feb. MACD line's crossed over. Oh, good Lord. It doesn't look good, does it? Yeah, so 6036 looks to be your, if you lose that as support, then I think you're in a pretty, you're in a large amount of trouble to the downside, possibly on FTSE. that would certainly reopen that sort of 5845 low from early March, and possibly even further worse. So it doesn't look all that great. Let's do one more, silver, because I know silver has been another big mover that I was looking at. Silver chart, big uptrend has been now lost. You've now sort of crossed below that uptrend. You've aborted the uptrend. Big bearish engulfing pattern, key one day reversal, whatever you want to call it. It's sort of flipped the sentiment around. You've got an RSI, basic RSI sell signal, I would say. But you've got the stochastics crossover, which is not too far from confirmation, and also a move below the reaction low here from late April would be a sort of bearish divergence with a failure swing on that. So that's, again, that wouldn't be positive either. It certainly looks as though we're seeing sort of downside now coming through, and your first support that's key is at 1672. But it looks, if this correction does take hold, that we could be sort of coming back to sort of this 16 area, doesn't it? Which is this reaction, these reaction highs here, which are old resistance becomes new support, 1615. So yeah, correction on the silver chart looks as though it's gathering pace now. So yeah, it is basically turned around. But these are all basically plays on the dollar that I've shown you, apart from obviously those equity markets. These are all pretty much plays on the dollar, and the dollar rally that we've seen in the last sort of day or so. Will it continue? I don't necessarily think it will. I think that there's only going to be one hike this year, and I think the market needs to still sort of still factor that in, really, despite these hawkish comments that we've had from Dennis Lockhart and John Williams yesterday. So I think that that's it. So that's pretty much concludes my presentation. I wish you good luck in all your trading. I'm going to be talking about growth indicators next time, and talking about PMIs and GDP and all that such like. So I wish you good luck in your trading, and I will speak to you again next time. Thank you.